Real-time trade setup. XRP just broke below the critical $2 support zone, and we're taking action. I'm opening a short position at $1.99 with the following setup. Stop loss $2.05, just above the failed neckline. Take profit 1, $1.75. Take profit 2, $1.50. Risk per trade, 1.5% of capital. This setup is based on a classic breakdown pattern, and we're not waiting for the crowd. Let's break down why this trade makes sense right now. Let's zoom out for a moment to the daily chart. Over the past 2 weeks, XRP has formed what many traders would call a textbook head and shoulders pattern, one of the most well-known and reliable reversal setups in technical analysis. If you're new to the concept, a head and shoulders consists of 3 peaks: the left shoulder, where price hits a high and retraces; a higher peak in the center, the head, which represents the final bullish push; and a lower high on the right, forming the right shoulder where momentum visibly weakens. All of these peaks are connected by a horizontal support line known as the neckline. And for XRP, that neckline set precisely at $2. Now, here's the key part. Today's candle didn't just touch that neckline. It closed decisively below it, and it did so on rising volume, one of the clearest signs that sellers are in control. Why does that matter? Because once a head and shoulders breaks the neckline with volume, it often triggers a trend continuation move to the downside. So where are we heading? If we apply the measured move technique, taking the vertical height from the head down to the neckline and projecting that same distance below the neckline, we get a downside target of around $1.50. That becomes our primary projection for this setup, and it aligns perfectly with our short bias as long as the price continues to trade below the $2 breakdown zone. Now, we never rely on chart patterns alone. Let's check the momentum. MACD is firmly in bearish territory. The signal line crossed down 3 days ago, and the histogram continues to expand negatively. RSI is sitting at 47, neutral but with plenty of room to drop into oversold territory. Funding rates on derivatives platforms like Binance and Bybit have turned negative, which means traders are now paying to hold shorts, a strong sentiment indicator. Want more confirmation? On-chain and market data shows $318 million worth of short positions open on XRP futures versus just $89 million in longs. This 3.5 to 1 short to long ratio shows heavy institutional positioning to the downside. It's not just retail fear. The smart money is betting on a breakdown. So what happens next if the short trade continues to play out? First, we're watching the $1.75 level. This is not a random number. It represents the last local support from late April, where buyers previously stepped in and price rebounded. It's also a psychological mid-range zone. If XRP stalls here, we may see temporary consolidation or a shallow bounce. That's why it's our first take-profit target. Now, if the bearish momentum stays strong, and if volume remains in favor of sellers, the next major level we're eyeing is $1.50. Why? Because that's the measured move target of the head and shoulders pattern we mentioned earlier. If you take the distance from the top of the head to the neckline and project it downward from the breakdown point at $2, it lands you right in the $1.50 zone, a classic charting technique used by professional traders. But there's one more layer to this. On the 4-hour chart, a descending triangle is taking shape. Lower highs pressing down with flat support trying to hold at the bottom. If this triangle breaks to the downside, and especially if it happens with high volume, we could be looking at something more serious, a flash drop to $1.18. That $1.18 isn't pulled out of thin air. It's a technical extension that matches a deeper Fibonacci retracement from the November rally, a low volume node on the volume profile, and an old demand zone from December 2023 that was never fully retested. So while $1.75 and $1.50 are realistic, $1.18 is the extreme case, a flush-out scenario if fear accelerates and liquidity gaps are exposed. As always, we don't predict, we prepare. And right now, the chart is giving us levels to respect. But let's be balanced. What would invalidate this short setup? A clear 4-hour close above $2.28 with strong volume would invalidate the bearish thesis and confirm a bullish falling wedge breakout. If that happens, I'll flip bias to long with targets at $2.46 and $2.57. That's why my stop loss is tight at $2.05, because capital preservation is more important than being right. Always remember, don't chase, wait for structure. Don't hope, manage risk. If you're trading this move with us, log it, size it right, and stick to your rules. For more live signals, real setups, and no BS market logic, subscribe now and hit the bell icon. I'll see you in the next trade setup.